So hello guys, welcome back to ROI Engineers. So today particularly in this video we'll be covering how as an investor how can we pick a right capital intensive business. So in this particular video we'll be covering all of this with real world ratios and case studies, and in the end we'll also give you a framework by which if you follow then there are very less chance that you fail as an investor to pick the right capital intensive business. Okay, so first before jumping into any ratios, let us understand what do we mean by the capital intensive business. Okay. So imagine you wanted to build a business that needs big machine, factories, and heavy infrastructure. So that is what do we mean by capital intensive business. A capital intensive business is the business wherein big money goes goes out and the profit comes much later. Okay. So capital intensive business require big factories, big machineries, big towers, big plant, and big infrastructure. So basically this kind of companies spend hundreds and thousands of crore before even earning rupees one. Okay. So this kind of capital intensive business have a very huge fixed asset base. Second, because of the fixed asset, they have a big depreciation and the interest cost because that much amount is being lended up by a bank. Okay. And third, because of big money, there is a long payback period. So that is the reason there is a higher interest rate cost. Okay. And particularly because of all such reason, this particular capital intensive business are very much sensitive towards heavy competition, material cost increase, and a slowdown. So they are very much insensitive. They are very much sensitive for all of such things. Okay. So now first let us understand between the difference between a high capital intensive business and a low capital intensive business. So in happiest mind in IT company, what happened in 2020? Before 2020, they were working on IT and SaaS softwares. Okay, but after 2020, they see a heavy demand in analytics, data analytics, IoTs, and everything. So they have shifted their direction from a SaaS software company to a IoT and analytics company. Okay, so this kind of flexibility we cannot have in capital intensive business. So that is the reason you cannot shut down your plant right now, and you cannot start working on building up next factory onto next product immediately. So that is the reason in this particular capital intensive business your money is locked in plants and equipment. You can't scale down quickly in a slowdown. So you have to be patient. Okay. Depreciation, maintenance, and interest keep hitting your profits whether you sell or not. So the game here is not just about building capacity. It is also about how well you manage your asset utilization, how well you manage your asset quality. Okay. Now let us understand why investor must be very much cautious. ओके सो ना अभी मैं आपको यहाँ पे ना एग्जांपल दूंगा इंडिया की लार्ज बड़ी बड़ी कंपनियों के बारे में जिनके पास अच्छा ब्रांड भी है, जिनके पास इतना अच्छा एसेट बेस होने के बाद भी they were not able to generate good profit return. They were not able to generate good return for the retail investor. Okay, so let us take an example of ATGL, Adani Total Gas Limited. So you can see Adani Total Gas Limited. Okay, so now ATGL is involved into the business of city gas distribution. Okay, so now you can read here that it is the company is among India's largest player in city gas distribution sector. Okay, so now let us understand what does the balance sheet of this particular company says to us. Okay, so if you look into the balance sheet, so out of the total asset, what is the percentage in the fixed asset? So you can see almost 50% is the fixed asset. The fixed asset involves land, building, plant machinery, equipment, and equipments. Okay, so almost 50% of the total asset is engaged into fixed asset. Okay. The interesting theory is that from year 2019, the company's fixed asset was worth only 1,000 crore. From there, it have grown up to 3,651. So basically 3.5x, they have increased their fixed asset base. Okay. Now let us take the same in their income statement. So from March 2019, they have increased their sale from 1,700 crore to 5,000 crore. And if you look into profit, 229 to 650 crore. So you can see merely they were not able to even justify that net profit growth. So basically, their asset have grown up to 3.5x, but their profit was not even able to double. So from 436 crore, they were not even able to double. Like they were not able to go till 800 crore. The second example, if you can see here, is the Bata India. Okay, Bata India Limited. Again, it is this company is the largest footwear retailer and leading manufacturing in India footwear industry. Okay, so now again, if you see the balance sheet of this particular company, again you can see that out of the total fixed asset and the fixed asset divided by the total asset ratio is somewhere around 50%. Okay, now here also you can see that the company was in 2019 was around 300 crore fixed asset, and they've grown their fixed asset from 300 to 1800 crore. So basically, they have six times their asset. Okay. Now, if you see the net profit, so the net profit is around 329 crore, and they were not even able to generate a positive profit growth. Oh, so that is the problem with Bata. Now, let us uh, check another example of IOL Chemical. Okay, so you know this company for painkiller. So it is the largest player of ibuprofen, that is the painkiller, globally with a world market share of 35%. Okay, now if you see this company's balance sheet, okay, now this company's balance sheet, so basically the fixed asset to the total asset ratio is almost zero point 0.5. So basically around 60 to 70% is been involved in the fixed asset. Okay, so 995 divided by 2051, it is roughly around 50, 40, 45%. Okay, now you can see here again as well, from a 600 crore company, they have gone up to 1.5. So basically they have doubled, two times, 2.5 times. Okay, now let us see the same thing in their profit margin. So you can see the profit margin from 237, the net profit is not even growing. So the problem here is, firstly with the sales haven't been so great, like the sales haven't been double, but at the same time, the material cost for the ibuprofen, for the raw material, it is increased from 72%, 70 and 66%. That is the reason, if you see, all of these companies have generated negative wealth for the retail investors. If you can see negative wealth. At the same time, if you see the ROC for all of this company, it is continuously declining. So if you can see ROC for this particular business, it has been continuously declining from 15% to 9%. So that is the reason you need to be very much cautious while picking up the right capital intensive business. Why? There is a upfront investment, and because of such a upfront investment, the capacity may remain underutilized. The case that you have seen with ATGL, the same the case that you have seen with Bata. So depreciation still drags profit even if sales drop. So you can see here as well with the example of Bata, that almost 30-40% of their profit is being captured by the interest and the depreciation. You can see that almost 300 or 300 crore from 427 crore is just the interest and the depreciation cost. Okay, so if this particular, all of this business is funded by the debt, the interest cost become a burden. So you have to always take interest coverage ratio whenever you invest in such a capital intensive business. So here the lesson is, bigger plant, bigger brand, growing asset is not a sign. It is not a good sign. So good sign will be bigger plant with better returns, and at the same time efficient plant. Okay, so the goal here is to select such a companies wherein asset is growing, but at the same time the utilization of the asset is happening, and at the same time the sale is supporting that particular asset. Let us jump into the ratio that you need to look before investing in capital intensive business. So the very first ratio comes is fixed asset turnover ratio. Now let us understand what this is. What does this fixed asset turnover ratio says about any business? Okay, really what it says that it compares sales with the fixed asset. So basically, it compares sales with the fixed asset. So now it measures that the sales generated per rupees of fixed asset. So basically, in the case of ATGL, we have seen that fixed asset were growing, but sales were not growing accordingly. So because of which it results into the loss. It results into the net. So basically, that results into the negative profit growth. Okay. So the higher it is, efficient asset use. So the lower it is, idle capacity. So basically, what does this fixed asset turnover ratio tell us? That it tells us about that the management is not just looking about, not just focusing on the building, capacity building, but they are also focusing on sales. They are also focusing on asset utilization. So that is the most important factor whenever we select any capital intensive business. So I will take some few example. So I will take an example of Adani Total Gas. Okay. So now I have, so the next net fixed asset turnover ratio for Adani from March 2018 to March 2025. You can see here that this particular business have shown from 3.1x to 1.5x. That means asset turnover ratio is continuously declining. That means sales is not as good as the growth in the fixed asset. So it is again a red flag when you select a capital intensive business. So now the green flag companies are, if I take an example of Hindalco, which are continuously improving their asset turnover ratio. the key point here is that even a marginal increment in net asset turnover ratio gives us a very big return in ROC. So if you take an example, so this particular company have doubled their asset turnover from 1.2 to 2.1x. Okay, so again it is a so basically it tells about management, that management is quite focus on overutilization of the asset. So you can see that the debt to equity ratio, again, it is also declining. And at the same time, if you see the ROCE for this particular company, from 8 to 10%, it has come to 15%, which is not bad at all. Now I will cover up another example. If you can see Ultratech Cement. Ultratech Cement also have seen, if you can see from zero point 0.7, they have gone up to 1.2x. Again, the net asset turnover ratio is growing. That is a positive sign. Here also you can see from 10%, it is been going up to 15%. So the more the net asset turnover ratio, the more the return the company earns, and the more net profit it generates, and at the same time, EPS growth is also happening. Okay. So the most important thing here is, for particular sectors, you need to compare the asset turnover ratio with your peers, and at the same time, you have to compare how the asset turnover ratio is, increasing or declining for that particular company. So that is a very big green flag or a very big signal of how to pick a capital intensive business by this particular ratio. Okay, so now let us jump into the second ratio. Now this second ratio shows a very simple thing कि मेरे टोटल एसेट में से मेरा फिक्स्ड एसेट कितना है। ओके, अगर मेरा फिक्स्ड एसेट बहुत ज्यादा है, इसका मतलब क्या हो गया, ये इट इज मोर कैपिटल इंटेंसिव। और अगर मेरा ये रेशियो कम है, दैट मींस इट इज अ फ्लेक्सिबल, इट इज मोर फ्लेक्सिबल। सो अगर आपको अगर ऐसी कोई कंपनी मिलती है जिनका फिक्स्ड एसेट डिवाइड बाय टोटल रेशियो, टोटल एसेट डिक्लाइन हो रहा है, दैट मींस द कंपनीज डिपेंडेंसी ऑन द फिक्स्ड एसेट इज डिक्लाइनिंग, दैट मींस इट इज अ पॉजिटिव एंड इट इज अ ग्रीन सिग्नल। ओके, सेकेंड चीज, अगर मेरा ये रेशियो रेस कर रहा है, मतलब अप हो रहा है, और एट द सेम टाइम मेरा एसेट टर्नओवर रेशियो या मेरा सेल्स भी डिक्लाइन कर रहा है, या सेल्स उतना ज्यादा नहीं बढ़ रहा है, दैट मींस इट इज अ रेड फ्लैग। कहीं ना कहीं कंपनी ज्यादा फिक्स एसेट रख रही है और कहीं ना कहीं वो एसेट यूटिलाइजेशन हो नहीं रहा है। इसी केस में इफ यू देयर इज एन एग्जांपल ऑफ ताज होटल। पहले ताज होटल क्या करता था ना, कोई भी बिल्डिंग बनाने से पहले ना, ही यूज्ड टू ओन दैट पर्टिकुलर लैंड। ओके, उसकी वजह से क्या होता था, उनका फिक्स एसेट काफी बढ़ जाता था, फिक्स एसेट डिवाइड बाय टोटल एसेट का रेशियो काफी बढ़ा था। बट नाउ उन्होंने अपना बिजनेस मॉडल शिफ्ट करके, दे हैव, instead of owning a land, they now lease that particular land. So because of which what happened is, उनका dependency on fixed asset कम हो गया, and that is a positive and a green signal from the management direction कि अगर ऐसा कोई आपको बिजनेस मिलता है जहां पे मैनेजमेंट खुद अपने बिजनेस का डिपेंडेंसी फिक्स एसेट पे कम कर रहा है, so again it is a green signal. Now let us jump on a very important ratio. This ratio is fixed asset divided by net profit. Okay, this is a very underrated ratio where people are not talking, but I think that when we are talking about capital intensive business, this ratio holds a major part. Okay, so I will tell you the importance of this particular ratio. So if you can see, it is fixed asset divided by net profit. Okay, so the first thing, suppose let us say this is my company, okay, and it is having 1,000 crore of fixed asset, and on 1,000 crore he is generating around 150 crore of net profit. I'm talking about net profit, not the operating profit. Okay, so now let us say the company says that they wanted to double up. Okay, so they have to increase their asset base from 1,000 crore to 2,000 crore, right? Now the important question here is, if they wanted to jump from 1,000 crore to 2,000 crore, or if they wanted to make their company double in size, okay, then the most important question here is that how this particular money from 1,000 crore to 2,000 crore is coming up. So basically, if this 1,000 crore is not coming from their own profit, then they are largely depending on what? They are largely depending on the bank or the dilution of their own share, which is a very big red signal. So basically, they are saying that इस बिजनेस में, ऐसे बिजनेस में उनके पास पोटेंशियल ही नहीं है ग्रोथ करने का, और अगर उनके पास पोटेंशियल नहीं है ग्रोथ करने का, दैट मीन्स जब कभी वो बिजनेस अपने आप को डबल करने के बारे में सोचती है, उनको बहुत ज्यादा लोन लेना पड़ेगा या फिर शेयर का डाइल्यूशन करना पड़ेगा। इसलिए ये रेशियो देखना काफी ज्यादा इंपॉर्टेंट है कि आपका आपका नेट प्रॉफिट जो आप साल के एंड में अर्न कर रहे हो, वो नेट प्रॉफिट क्या मेरे फिक्स एसेट को फंड कर सकता है या नहीं कर सकता। सो दैट इज द रीजन वी हैव टू चेक दिस पर्टिकुलर रेशियो। ओके, so now the lower it is, the more efficient it is. So when it is lower, that means net profit is supporting the fixed asset, so it is a green signal. Okay, the higher it is, that means it is a weak profitable company. Okay, and they are not able to fund their own company's growth. So for an example, if I take an example of, okay, let us take an example of SAIL, Steel Authority of Steel Authority India Limited. Okay, so if you see here, give me just 1 minute. If you see here, the fixed asset for this particular company is around 73,000 crore. Okay, so now if they wanted to double, so basically now let us go to the income statement. Income statement, profit after tax, it is just 2,2372 crore. Okay, so basically now if you see a particular ratio from 72,000 crore, they only earn 2,000 crore. That means their fixed asset to the net profit ratio is 36 times. That means even if they take loan, they will have a huge loan of 36 times. So basically 36 ईयर का लोन टेन्योर पीरियड हो सकता है, वो भी अगर उन्होंने पूरा का पूरा नेट प्रॉफिट अगर सिर्फ लोन को भरने में किया. So that means this company is not having, self-funding capability. From this ratio, you can understand it. I will take another example of Avenue Supermart, that is DMart. So now, if you can see this particular thing, that the fixed asset for this particular company is 16,000 crore. Okay, and if you see income statement here, if you see income statement here, it is roughly around 3,000 crore. Okay, so from a 16,000 crore, from 16,000 they're having roughly around 3,000 crore. So this ratio says only 5. And the most important thing, if you are aware and if you go and check the annual report of the DMart in this particular year, they have opened 60 new stores. And for a one particular store, if the average cost comes around 60, okay, so you can see here that 60 into 60 crore into 5 is around somewhere around 3,000 crore. So for all the 3,000, for all the new stores, they are able to fund themselves. They are able to fund themselves, so they don't need to take loan for their future growth. So this ratio is around 5 or 10. So that means the company need to take around the loan of 5 or 10 years, which is okay, which is good. Like many capital intensive business do that. Let us take another example of Hindalco. Okay, now again, Hindalco, if you see, the fixed asset is around 1,16,000 crore. Okay, and the income statement, the profit after tax, if you see here, is around 16,000 crore. So basically, 116 divided by 16. Again, it is roughly around 7, and it is it is inside 10. So again, it is also great signature that Hindalco, if they wanted to double their asset base or double their business, they can fund themselves very well from their own net profit. Okay, so basically now let us try to build a framework or the key points that you need to check before analyzing or before picking up capital intensive business as your next investment. Okay, so first most important thing, you need to check that this particular business or this particular business is how much asset intensity. So basically how much it is dependent on fixed asset and what is the portion of fixed asset from the total asset. That is the important thing that you need to check, because it tells you about the rigidity and the flexibility of the company. Second thing that you need to check is the utilization. So basically, we have seen a big example out here that the asset is growing up, but the sales is not growing up. The most important reason is the utilization is not happening. Okay. And the third thing that you need to check in any company is profit. So basically, with the asset that is been growing, is profit also growing? So basically, profit link you have to check, because the most important thing, this kind of capital intensive business is very much sensitive towards competitiveness and at the same time to the raw material cost. And if you timely check this profit link, then you can figure out that there is some material cost increase and or the competitiveness in that particular business. So that is the reason this profit link needs to be checked. And the fourth thing is, whatever the loan the company have taken, how much repayment they are doing it, and debt to equity ratio is continuously declining or not. Why? Because when we are taking such a when we are such running such a big asset heavy business, the main goal for the management is the utilization of the asset and at the same time the repayment of the loan. Okay, so the depth and the dilution rate, like I said in the previous slide, that whatever the company is, if they wanted to double it, is that growth being funded by their own net profit? If it is not, then there is a major chance or major risk of depth and dilution. Okay, and again, so basically all of this, whatever we have discussed, it needs to be checked with the peer in the same sector. Then you can understand, or you can pick certain good companies in capital intensive business wherein the asset is also growing, sales is also growing, and at the same time return is also being generated. Okay, so basically now let us come to the last slide. So basically whatever we have learned here, I hope that it have added some value as an investor into your life. So basically what I wanted to share from this particular video is capital intensive business is not bad, but the only danger thing is if the profits are not supporting that particular business, then it is a big red signal. So in short, what I wanted to convey here is that fixed asset tells you what the company owns, but at the same time, net profit tell you what it earns, and the ratio tells you how strong truly is. That's how you separate a capital intensive try from a wealth creating machine. Okay, so if you need to double a fixed asset, but profits can't support, you will either take more debt or dilute the equity. Okay, so in any qualitative capital intensive business, the most important thing is borrowing should not be taken continuously to support the growth. So that is a red signal. So that is what I wanted to say. Always ask one simple question before investing in any capital intensive business is, can this company be funded by future expansion internally or by their own profit and by not taking a lot of debt. Okay. With this, thank you so much. Subscribe for RO Engineer for more such videos. Thank you so much.